Welcome to Property Chat with Pete. This is your host, Peter Harley. And thank you so much for joining me. This episode is episode number 11. And today we'll be talking about first home buyers and what you need in order for you to get into a property as a first home buyer to get yourself started. So the first thing you need to look at, which is quite obvious, is a deposit. So we'll be talking about the options you have available for you if you aren't able to save up a deposit and you're afraid that the market is never going to be right for you to actually set your foot into the market. So you want to get your foot into it and you want to get an opportunity to start building that equity, which will give you the leverage you need in order for you to buy your next property or buy more properties or sell it or whatever you need to do in order for you to get to your next stage of life. So let's talk about a deposit. The first thing you need to think about is the deposit. Now, to save up at least 5%, which is approximately, if you think about a $500,000 house, you're looking at about $25,000. And as a 5% deposit, which many banks are willing to borrow you 95% of the loan, so of the purchase price, with taking into account whatever government grants and so forth you have access to. But if you have the ability to save up, let's say $200 every week, which for many people is very challenging, especially in this day and age where there's inflation and there's all these expenses coming out of our ears. So $200 every week, that'll take you more or less two years, just over 2 years to get to $25,000. Now that's a long time. Within 2 years, the property market could have gone up in such a significant way that you'd have to save up $50,000 by the time you get there in order to get your 5% deposit to the property that used to be $500,000, but has now climbed up to, let's say, $750,000 or more. So what are your other options? What is it that you can do to get your foot in the door as quickly as possible? Hopefully you've got access to Bank of Mum and Dad. And Mum and Dad, if you're listening to this as well, remember that this is not a case of you just giving your child something for the sake of them being in need of having to find their first home. And it's not a privilege per se, although it is a blessing for you to be able to do that. You can set it up in a way that they can pay you back if you're not willing to gift it, which is one of the options. So the first option is gifting. As a parent, if you're willing to, or if you're in a position to do so, you can gift your child the deposit towards the property purchase, and they'll be able to buy their first home and not be stuck renting someone else's property for however long it may take for them to save up their deposit. That could be the first option. If you are able to do that, that'll be great. Obviously, there needs to be a stipulation of some sort, which we can discuss with your mortgage broker or banker, stating that this is a gift and I don't expect it back. You have to do that in writing in a declaration form. All right. Number 2 option that you could have, Bank of Mum and Dad, you could loan the money to your child. If you're that way inclined, you can definitely loan the money to your child, but you have to remember that there are certain characteristics of a true loan, which is very important, and you need to remember that. You need to make sure that there is a genuine expectation that you're going to be getting the money back. How are you going to be getting the money back? You need to come to an agreement to that. You need to, if you can, preferably document it in a way that's going to be legally viable for you to back onto if it comes to a point where you need to claim that money back. So you need to create some sort of legal or binding agreement between yourselves saying, I'm not gifting, but I'm loaning you this amount of money. You need to pay it back to me on this terms. So whether it is that you agree to pay it off on a monthly basis or a yearly basis, or whenever he or she gets a tax return or they get a tax return, whatever agreement you've come to, or you could say I'm loaning it to you to the point where there's enough equity in the property when at that stage you'll have to pay me back. And if the equity is not met within 2 years of you having the property, we will then need to come to terms of an agreement of you paying it off on a repayment basis of a minimum of X amount. So those are the things you can discuss and come to agreement on, and put some documentation in place to ensure that you and your child don't have issue with the agreement later in life, and also ensure that if there is a partner involved with the first homeowner or your child's purchase of the property, that's all written down and it's all very clear, so that everyone's legally binding to the agreement that you have. Okay. The third and final option that as a parent or as a child you could have access to is that your parents may not have money in the bank, but they may have a property that is worth a lot more than what their loan is. So they may have equity available, usable equity available, that they could say, look, the bank needs to be generally the same bank that you're going to be borrowing from. It may be different. You need to discuss that with your mortgage broker. But at that stage, what the parent could then do, or your mum and dad could do, is say, okay, fine, we're willing to give you the 20% deposit you need towards your purchase. There's no money coming out of our pocket. It's not a borrowing. It's more of a guarantee that this amount of money they can take off the property that we currently own and apply it to the property that you're going to be purchasing. Okay, being the 80% of the loan would then be on you. You'd need to pay the 80% of that overall purchase. However, there also needs to be taken note that potentially, if it is that they can't give you the full 80 or the full 20%, you will then generally need to pay LMI. But if they are in a position where their property is worth a lot more, they could potentially give you the full 20% you need. So lender's mortgage insurance won't be applicable, and therefore you'd save thousands of dollars. All right. So this is important. But another thing to note is that when the actual guarantor bit falls away, it only falls away at the stage at which your property grows in value over and above that figure of whatever the value was. So if you borrowed, let's say $1 million, or you wanted to purchase a property worth $1 million, and there's an $800,000 loan that you had to repay, okay, which means that your parents' property had to guarantee $200,000. If the value of your property goes up in such a way where it's now worth $1.2 million, for example, that $200,000 can then be taken off the guarantee bit. You can then release your parents' property from the guarantee, and they can then go on their merry way as if nothing happened. So there's a way that you could potentially get out of it by adding value to the property, or potentially buying a property at a really low price and it's under market value, or it's at a stage at which you know that the property is not finished, or it's going to be built at some stage, and when it is finished, it potentially will grow in value to such a stage that you wouldn't even need the guarantee any longer. So there's all these factors you can think about and take into account. However, in the event of the unfortunate circumstance that you are not able to meet the terms of the loan that you currently have on your loan, because of your parents guaranteeing that 20%, for example, of the overall value of the property, they will then be liable for the loan. All right. However, the property would first what the bank will do is the bank will first sell your property and get as much money as possible from the sale of your property to cover as much of the loan as possible. But if there's still any amount left over that is within that guarantee space, or any amount at all that's left over, would then be the liability of your parents. So parents, be aware of that. However, make sure that you help your children make the smart decision and get a professionals involved with the purchase, so that there's no hiccups, so there's no misunderstanding of value in terms of the property that's being purchased. So make sure you reach out to me. Go to my website, peterharleyconsulting.com. Reach out to me via the form online there, so that I can get you in touch with one of our professionals, be it a buyer's agent, be it a solicitor who can help you with all the documentation and so forth. or be it an accountant to just figure out whether or not it makes sense financially for you guys. But yeah, feel free to reach out, and wishing you all the best on your property buying, selling, developing journey, and here to help if you need at any point.